Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 3rd of April, so the markets are quite volatile. Equity indices have fallen across the board and the US dollar is also sharply lower. Even gold is lower at the time of recording as investors move out of all sorts of risk assets following last night's announcement of the latest tariffs, which were significantly higher than the market had expected. Anyway, let's now look at a few charts. So starting with the S&P 500, as you can see, the trend is clearly bearish with the market creating lower lows and lower highs. And yesterday, it completely engulfed the previous day's small recovery to create a bearish engulfing candle on the daily time frame, which is a bearish reversal pattern. And we've seen some further follow-up technical selling following the formation of that candlestick yesterday. So the path of least resistance clearly remains to the downside, and we could be going further lower in the near-term outlook before the buyers potentially step in. With the market now below the 61.8% Fibonacci retracement level against the August rally, the next downside target could well be the 78.6% of that move, or ahead of that we have this low coming in at 5,385, which corresponds with the low of September. So that could be the next downside target for the bears. Below that, the 78.6, and then the August low itself comes in at 5,090. Could we get all the way down to there? Remains to be seen. But for now, those are the short-term targets for the bears. In terms of resistance levels to watch, well, the prior support levels that gave way are now going to be the most important resistance levels to watch, including the low from Wednesday, which comes in at 5,524. That level is now going to be important. It needs to hold as resistance for the bears to remain in control. But should we go above that level, then I think that would be a short-term bullish development, in which case we could see a short squeeze rally towards the resistance trend line once more. So as things stand, therefore, the technical path of least resistance is clearly to the downside. And for the market to turn bullish, we will need the formation of a key reversal pattern or a break back above this bearish trend line that has been in place since the markets peaked in February. For that to happen, you'd feel that the Fed might come to the rescue by potentially cutting interest rates sooner than expected, although their hands will be tied because tariffs are expected to boost inflation. So a more plausible explanation for a potential market recovery could be if Trump reduces trade tariffs, or the countries affected, including the Eurozone, agrees to some sort of a trade deal with the US that would allow the two sides to trade more freely. But in the short term, there's a risk that we could well see some retaliation, at least from Europe and elsewhere. Now, looking at the German DAX index, well, it has fallen along with other global indices, and right now it is finding some support around the trend line that has been in place since August of last year, and it has bounced from there. But a potential daily close below this trend line could well pave the way for further technical selling, which could make things more interesting in the days ahead. In terms of resistance levels to watch, well, this level right here at 22,117 to be precise is the most important resistance level to watch, given that it was the most significant low prior to the index making an all-time high. Now that we've broken below it decisively, it is offering some resistance, as you can see by the wick of today's candle. However, if we go back above it on a daily closing basis, ideally, I think that would be a bullish scenario. Now, the dollar is weaker across the board, and as I've been expecting the euro dollar to break out from this consolidation pattern, which it has now because of concerns about stagflation in the US economy, we have seen a big rally once we broke out of the resistance trend of this pattern to the upside. It has broken key areas of resistance, including 109, 109.50, and 110, which was my main upside target. It has gone well above that today to hit 111, I think 111.50 almost, but it could potentially extend further to rise towards the high that was hit last September at 112.14. That could well be the next upside target for the bulls, and could we get there today? Remains to be seen, but for now, at least the path of least resistance is to the upside. But if things start to unravel and we go back below this shaded green area, I think at that point the technical outlook on the euro dollar would flip to being bearish. But as things stand, that doesn't appear to be likely. We're seeing a very similar pattern across the forex markets, and for the reasons why the dollar has sold off and where we think it's going to go to next. Make sure to read the article I posted earlier, the link of which is attached to the description of this video. So make sure to click on that and read it if you're more interested. And for more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.